What do LELOCs and bell-bottom pants have in common? If you don't know, stick around. Join us for this episode. We're going to enlighten you.
Enjoy the episode.
If you're an investor or want to be an investor and you're looking to create passive income that exceeds your monthly expenses, then this is the podcast for you. Here on the Infinite Wealth Podcast, we combine the philosophies of Robert Kiyosaki's Rich Dad, Poor Dad, along with Nelson Nash's infinite banking concept. Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso, and today we're going to be talking about the commonality between LELOCs and bell-bottom pants. And if you guys don't know what LELOC is, you're in the right place because we're going to be talking about both of these.
And everybody knows what bell-bottom pants are. I mean, you're actually sporting a nice set today, but unfortunately, people can't see.
Fortunately for you guys. Guys, we're going to be talking about kind of that connection between LELOCs, and then we'll throw in some humor with the bell-bottom pants. Anthony, before we get into kind of today's podcast, let's talk about why we're talking about it, right? So why is this important? Why do you think we're bringing this back up?
Well, if you haven't heard about what a LELOC is, we're going to explain it here real quickly, but it's just a way to access the cash value of your policy. And when interest rates were really low, interest rates on these LELOCs were really low. And again, we're going to get into it, but the interest rate is tied to the U.S. prime rate. So when the U.S. prime rate was very small, so was the interest rate on these LELOCs. I remember the lowest point, they were 3%.
Yeah.
Right. So there's a lower floor. But as interest rates shot up, so did so did the rates for the LELOC. So a lot of clients, it just really wasn't conducive, only maybe in a rare situation.
Yeah.
And I will say I did keep my LELOC during this time, but honestly, it was I was a little too lazy to try to unwind the deal. And I'm just like, well, it's going to go down. But then finally it did. But now with these lower interest rates, these LELOCs are back in fashion, just like Cameron's favorite pants, bell bottoms.
And just like Anthony being too lazy to change or unwind it, I've been too lazy to change my wardrobe. So I've been rocking bell bottoms for a while now. But all right, guys, let's talk about what LELOCs are, right? If you are a listener to this show, we hope you understand at this point that one of the advantages that we're using with whole life insurance is the ability to collateralize the cash value with that insurance company. So we build up cash value, we can take a loan against it with the insurance company. What we're doing with the LELOC, and that LELOC stands for Life Equity Line of Credit, is we're actually taking the cash value that's in that policy and we're going to a third party. We're going to a bank and we're asking them if we can collateralize the cash value in that policy and take a loan against it. And a lot of banks will do that. We've got kind of a staple of banks that we work with in doing this. And it works. The idea of this, or the concept, is actually very similar to a home equity line of credit or a HELOC, hence the name LELOC, right? So with a HELOC, what you're doing is you are collateralizing the equity in your house. And with the LELOC, you're collateralizing the cash value in your policy. And so the banks are going to leverage and loan against both of those accounts based upon their risk. And so we've got opportunities there with both of those items. One thing I will say before we get into this is, Anthony, you can attest to this, but I would say that a lot of IBC purists would not be a fan of this idea of a LELOC. Would you agree with that statement?
Yeah, I would agree. Well, because I've gotten in some long discussions with some other IBC purists on whether this is something that we should be recommending to our clients.
Yeah. One of Nelson Nash's rules in his book is don't do business with banks. And we abide by that. What I would say is that I personally am looking for opportunities that are in my favor. And when interest rates are low, I think a LELOC is a great opportunity for myself. And I have made that recommendation to clients.
And I think part of the if we look back to what's the reasoning behind Nelson's rule is in large part, there's a big movement, and it's getting a little louder now, of ending the Federal Reserve. And what many people's goals were that if 10% of the people were practicing infinite banking, meaning not going to banks to store their money or to loan the money, that the government would lose the power of having the Federal Reserve. Not that I want to go too deep into the pros and cons of the Federal Reserve, but one thing that is interesting, I've always, my take was I would love to get rid of it. I just don't see the people wanting it bad enough to force the politicians to release the power that the government has on that.
Yeah.
However, I don't know. Right now, there's been
crazy
some more
time.
talk.
Yeah.
Like what's interesting, I don't want to get too much into economics, but if you follow Argentina, all of the issues that they had with the deficits and the overspending, and they started to incorporate some of these concepts. And I'm not talking about infinite banking, but really the basis, if we go into economics, is more of a Austrian-based economics. But he has went in there and he's incorporating Austrian economics in with that country,
Yeah.
and they're doing very well. And there's some talk about maybe that spreading and maybe that's something doing in the United States. So that would be great. But I would say at the bottom line is we're going to recommend whatever we think is best interest for our clients. If they want to follow the rules, totally understand. But we're just really looking at the data and explaining what we think is best to for our clients. And honestly, I'm using a LELOC, so I don't have a problem with it, but some people do. So we just want to be a little more open about that.
Yeah. And for any of you guys that have those issues that are concerned, you can email Anthony at anthony@infinitewealthcoach.com. Let's move on. Anthony, what are the advantages of a LELOC? Why would someone even consider it?
I would you know what the biggest advantage is now we're working through a bank, right? So just like Cameron had said, it's really the same process. Just who are we going to borrow money from using our policy as collateral? By using the bank, we now have bank privileges, meaning you have checkbook access.
Yeah.
So if I need to write a check to a contractor, or I can just simply write them a check. I don't have to worry about having to process a policy loan. We can get same day wires. As a matter of fact, I just took a policy loan today, and I can do an ACH and get it into my account in about 3 days. Now, some insurance companies will allow you to process loans online. But one thing that's been happening, and you may have seen this, they've been taking longer. And the reason being is there's been some fraud with people applying for these loans and putting the cash in somebody else's account. So the insurance company is trying to be a good steward and doing some verification on the loan was processed and the bank account, which is just adding some delays. But here, I think the biggest advantage is that you have access to that money right away. Also, one advantage is you can borrow up to 100% of your cash value. Now, when we're doing a policy loan, we're limited to 95. Here we have the ability to leverage 100%. But however, we always caution people in regards to doing that, because if we should never deploy 100% of our liquidity. We need to have some money in reserves for when life happens. And I think the best place to store those reserves are inside a policy. Mm-hmm. So we need to have access to those reserves for you personally. And also we always recommend you have about 1 year's have-to premium in liquid. So if you deploy all that money into an asset and things it takes a little longer to get the money out than you thought, we have that cash value in your policy that we can use that to pay the premium. So we do need to be careful about borrowing against 100% of the cash value. But I will say that is something that I do because I want to maximize the cash. But I'm also a good steward, and I'm not leveraging 100%. But I do like that ability if I do need to.
Good point.
And also, maybe we're talking a little bit about that. when the increase in lines on the disadvantages, but maybe I'll touch it on that point. Also, one of the advantages of a LELOC, it's easier to manage, particularly if you have multiple policies. Because typically, if let's say you get a policy on each member of your family, maybe you got 4 policies, maybe you need a policy loan, put a down payment on an asset. You may need to tap into 3 of maybe 4 of those policies.
Mm-hmm.
So now there's 4 loan forms as opposed to 1. But then also when you go and receive the money and go to pay it back in those policies, now you have to figure out which, how do you apply those loan repayments? What a LELOC does, it combines all of the policies, or really all the policies that you choose to use. So it makes it very easy. It's 1 line of credit and it's 1 loan repayment. Also, once you set this up, there are no loan forms, because also one admin burden when you get a loan form, particularly in a community property state, your spouse, if you're married, needs to sign that form as well. And just as I alluded to before, if we're ended up tapping 4 policies, technically that's 8 signatures.
Yeah,
which we can do through DocuSign, right? But I know for me, it's just always a burden having to explain to my wife why we need this money. Not that we're hiding anything by any means, but it just, sometimes I just need the money and I just don't want to have that extra burden of explaining it.
Anthony, if I have a question here, is that I heard you say that it's easier to manage once you get it set up. What's the expectation on timelines that you share with clients on, hey, how long is it going to take to get this thing set up?
For what we've been seeing here, it's been about 2 weeks.
Okay. Yeah.
Okay.
Same. Great point.
Again, when some other advantages are with the ease of use, there are no loan forms because we've already applied for the line of credit. To me, it's easier to manage like your loan because it's 1 loan as opposed to having multiple. Also, it's a little cleaner. It's easier to see it all in one spot in the website. It's also cleaner for tax purposes, right? It's harder to explain to your CPA that this interest is deductible, that we're going to the insurance company, but to explain to him or her this is interest for a line of credit that you use for business purposes is very easy.
Mm-hmm.
Another advantage of a LELOC is the potential of a lower interest rate. Also, and here's an advantage: if you have some policies at a direct recognition company, and let me just step back to define that. A company, on how they apply their dividends, there's really 2 ways they apply it: either direct recognition or non-direct. And if it's direct recognition, that means they directly recognize when you have a loan out, and they may pay a smaller dividend on the amount you have loaned out versus the amount that you have unloaned. If it's a non-direct recognition company, they don't recognize where you have a loan or not. So thus the advantage is if you're working with a direct recognition company and you use a LELOC, technically you don't have a policy loan. So thus we don't have to worry about the potential of getting a smaller dividend.
Great.
Anything you want to add to the pros there, Cam?
No, you did a good job going through the advantages, surprisingly.
Yeah.
I was going to highlight maybe some of the disadvantages of setting up a LELOC.
Mm-hmm.
One of the first ones that when we bring up a LELOC opportunity to clients that I'm discussing is that there are minimums. So we can't just have 20 grand of cash value and put that up. Is most of the time the minimum amount that banks are going to lend against is about $65,000. So we've got to have about $65,000 of cash value for us to be able to take that account and go and collateralize it with the bank. So that's the first one. The second disadvantage that I've noticed is actually required interest payments, either monthly or quarterly. And the reason I highlight this as a disadvantage is because a lot of clients get used to working with insurance companies where we control the entirety of that process. When we use a bank, is now we're giving up a little bit of that control, is because now they're able to dictate some of the rules to us. And that loan repayment schedule, at least on the interest, is one of those items that they do require. And so that's one that jumps out to me.
And I know that that one was a big one for you.
It was. I currently do not have a LELOC. I've got more policies than Anthony that I personally own. I don't know. But I do have many policies. But again, to be honest with you, is I don't like people telling me what to do, to be honest. And so required quarterly payments is not something I like. I like to be able to pay it when I want to pay it.
Let me just, on the flip side of that, that's something I do like about the LELOC. Now, I mean, I do like having that flexibility. I also don't like people telling me what to do, but cash flow wise, this is, at least for me, easier to manage. If I'm paying the interest on a regular basis, then I don't have a large interest payment due. So for me, cash flow wise, it is easier to spread that out. And also, if I needed to, I could use a LELOC to pay that interest. But again, this is a great thing, is that this will work for some people and some people it won't. But that's why we're taking the time to explain both sides of it.
Yeah. And again, I don't think it's just because I don't have one right now. I think a lot of clients will use one at certain times and not use one at different times, right? So, right, I think this is why we're bringing this conversation up, is because at more times there's maybe some of these advantages that are working for us, and maybe other times there's more of these disadvantages that are working for us. Back to the disadvantages, right, is typically there's only going to be an increase on your line of credit twice a year. And so the way that kind of translates practically to a client is if somebody's paying monthly, right, we've got an increase in cash value every single month, but the bank is not going to automatically increase our cash value or our line of credit. Is we've got to reach out to them and we've got to ask them to do that. And again, we're limited to twice a year. And so there'll be some months where you make a payment and you're not going to have access to that right away. And so that would be a disadvantage that we need to pay attention to. The other part the other disadvantage I'd make point of is that there is additional process to setting up the line of credit. And when they do that, there is a soft credit check. And so we always want to make sure clients are aware of that. Interest rates are more volatile. Again, we're using a bank, so they're going to dictate that loan interest rate for us. And so they can move. They're typically going to be attached to prime, and those can move monthly. The other one is that if you do try to unwind the LELOC, it can take a period of time for them to kind of release those funds and get it back to us. Anthony, I know you've had experience with this. Do you mind sharing kind of the time frame that it took for you?
I had a client where it just didn't make sense for them to maintain the LELOC, but so we would gladly help them process the paperwork to unwind it. However, it did take some time for the bank and the insurance company to finally process the paperwork, which means during that time, you may not have access to your cash value. So that is something to keep in mind if you are going to be doing the LELOC.
Great. All right, guys. So we've gone through kind of what is a LELOC, the advantages and the disadvantages. And now let's talk about who this is for. Anthony, do you want to highlight maybe some target markets for this? Who's this a good idea for?
I think the LELOC is great for people that meet a couple criteria. One, it's great is if you have multiple policies and you use those policies often and you're not interest rate sensitive. So if that interest rate does shoot up, it's not going to hinder your overall plan. But Karen, what would you say that the LELOC is not for?
I think I highlighted this earlier, but explicitly, there's two things that come to my mind. One is if someone has less than 70,000, 65,000 a cash value, it's not really even an option for them. So that's not a good fit. And then the other one is if somebody is funded monthly and they need the liquidity. If you're anticipating you're needing that here pretty quickly, a LELOC, because of that lag and the increase in the line twice annually, it's not a good fit. I would probably stay away from that.
You know what I would say is if you're not sure if this is for you or not, get on the call with us. Just email your coach and they can explain it. And as if maybe have your policies with somebody else and are interested in the LELOC, get on a discovery call with us and we can talk about the pros and cons of this and see if this is a good fit for you. Link for that will be in the show notes.
Nice. Guys, hope you enjoyed this episode. Again, we're bringing this up because the popularity of collateralizing our policies with banks is gaining interest as interest rates are coming down. So we hope you guys found this valuable and insightful.
Go make it a fantastic day.
Take care.
If you like this video, I know you're like this one. And if you want to learn how investors use infinite banking to increase their returns and lower their taxes, check this out. And if you have some questions and want to see if infinite banking is for you, hop on a discovery call with us. Link for that will be in the description.